Happy New Year, ma'am.
Thank you, ma'am. Wish you the same.
Thank you, ma'am.
This new year, 1 minute, just. In this new year, this is the first class. And how are you? First of all, how are you, all of you?
Good, madam. Good.
Okay. Okay. So already you know that have started the class. We have completed the 3 classes from my part, and you know that I'm handling the semester 1. The subject is business organization. In that 3 classes, I completed 3 blocks. Excuse me, please mute yourself, all of you. Please mute yourself.
Sorry, madam.
Okay. So this is the first class in this year. That is the 4th class. So today I'm going to discuss the 4th block. Already I completed the 3 blocks. So today we are going to discuss the 4th block. So just to recap here, just you see here, the syllabus at a glance, totally 5 blocks we completed in the 3 classes, the 3 blocks, block number 1, 2, 3. That means we discussed the topic under the first block is introduction to business. In the second block is, and second and third block is one concept, that is part 1 and part 2, that is forms of business organization, where in the block number 2, we discussed the first 3 forms, that is sole proprietorship, Hindu undivided family, partnership and cooperative societies. And the important form of the business organization of all the business organization is joint stock company, come under the block number 3. So now in the block number 4, we are going to discuss the single concept, that is sources of finance. So now here you see sources of finance. So already know that finance or the capital is the lifeblood of every business enterprise. So money used. So first of all, what do you mean by the word finance? Finance is nothing but the money used to purchase things the business needs or want. So that is why we regard this finance as the lifeblood of every business enterprise. So without finance, we cannot do anything. So now coming to the second word in our block, that is sources. If you combine both, what do you mean by sources of finance? So first we discuss the meaning of the title of this block number 4. So already told you that finance is nothing but the money used to purchase things the business needs or want. So these sources of finance, if you combine the word, if you combine the finance with the word sources, it means that here it is a method of getting hold the money you need. That is called as sources of finance. That means this sources of finance is the most explored area, especially for the entrepreneurs about to start a new business. This sources of finance is perhaps the toughest part of all the business efforts. So how can we get this? Please mute yourself.
Ma'am, this first semester business organization Commerce-10 kada ma'am?
Sorry?
First semester business organization class kada madam idi?
Avunamma.
Okay ma'am, thank you.
Okay. Please mute yourself. Please mute yourself. Okay. So this finance, that means this business finance is very, very essential I'm telling that here this finance is the lifeblood of business. So for what purpose it is required? For what purpose we use this finance for the business? It is used for two purposes. One, that means this finance means this capital is utilized for two purposes. So whether it is one or two purposes, remember that this finance is required to establish or operate the business activities and expand in the future. So for what purposes these are utilized? For two purposes it is utilized. One is, the first purpose is called as for the, that is fixed purpose. That means it is called as fixed capital. So the, what do you mean by that here? Funds which are specifically required. 1 minute. So funds which are specifically required for purchasing of the different or the various purchase of different type of tangible assets. Tangible means that you can see and touch. That is called as tangible. Tangible assets means, what are tangible assets? Furniture, machinery, buildings, office, factories, intangible assets like patents, trademarks, etc. All are the tangible assets. So whatever the finance or the funds which are required to purchase all these tangible assets, that is one type of finance, that is fixed, that will be fixed. If you purchase for one time for the long period, you need not invest every year, you need not spend every year. Other than this, so that is called as fixed capital. Other than this, there is second type of finance or capital called as working capital, also called as running capital. So what does it mean here? That means every day you need some day-to-day, you want to meet some day-to-day expenditure. That means you need some fund for meeting out the day-to-day expenditure, for meeting of the day-to-day operational activities of the business. So like, for example, you want to use these funds for the purchasing of the raw materials or the payment of wages or the salaries or the any type of bills or collecting the money from the clients, etc. So for that also you need some finance or the capital, that is called as working capital. That means running capital. For the day-to-day running of your business, you need some capital, that is also called as working capital. So this working capital is very essential to have the sufficient amount of money to survive and grow the business. So thus we can say that here, in this regard, whether it is fixed capital or working capital, remember that we need here for different, that means we need in different sources. So what are those sources here? Just you see the picture here, you can see this slide. In three different sources, we need this finance. One is basing on the time, means time period. Second one is basing on the ownership and control. And third one is basing on the source of generation. So the first one is basing on the time period. Second one is basing on the ownership and control. Third one is basing on the sources of generation. So now first you take the first category, basing on the time. Just at a glance, just you see the picture here, whether it is a time or ownership or control or the sources of generation, whatever it is, some sources are being repeated. So what are they? At a glance, just let us discuss here. So first we will see basing on the time period. So basing on the time period means here, it can be the period basis is further divided into three subdivisions. One is for the long-term source of finance. The second one is medium-term source of finance. Third one is short-term source of finance. What is the first one? Long-term source of finance. What does it mean here? This long-term fund is utilized for more than 5 years. That means the fund is arranged through different sources for more than 5 years. The fund is utilized for purchasing or meeting through either equity shares or preference shares, etc., etc., and is accumulated from the capital market. For the long-term period, that is more than 5 years. That term of source of finance is called as long-term source of finance. Coming to the second one, medium-term source of finance. These are the short-term funds that last more than 1 year and less than 5 years. So what is at a long-term means more than 5 years. Now what is medium-term? Between 1 to 5 years. Then what is short-term? Less than 1 year. Again, I repeat, long-term means, first let me tell, short-term means less than 1 year, medium-term means 1 to 5 years, and long-term means more than 5 years. So if the, coming to the second one, medium-term means between 1 to 5 years. That means more than 1 year, but less than 5 years. So under this category, remember that this source includes borrowings from the public deposit and the commercial banks or the commercial papers or the loans from the different financial institutions or the government or from the commercial banks or the lease financing, etc., etc. So that type of source of finance is called as medium-term source of finance. Third one is short-term source of finance. Short-term source of finance are the funds that are required for a year, means less than 1 year. Mostly the running or the working capital loans from the commercial banks and the trade credit, etc. are the examples of these sources.
Sorry
So
for
here, if you see,
again, you can explain medium time source of finance.
Again, shall I repeat again?
Yes, ma'am. Yes, ma'am. Thank you.
Okay. So again, I repeat once more. Here you see basing on the time period. Time period means basing on the year. So first you see short term means less than 1 year. Medium term means 1 to 5 years. Long term means more than 5 years. Now we are discussing already you have asked about the medium term, right? Medium term means what is the time period I told? Between 1 to 5 years means more than 1 year and less than 5 years is called as medium term. So this medium term source of finance, it includes, that means not only the different shares or the debentures or the bonds, at the same time the different borrowings from the public deposits, either from the commercial banks or the financial institutions or from the government or any type of commercial papers or the lease financing, etc., etc. So all these sources of finance comes under the second period, that is medium-term source of finance. Hope you understood it. Third one is short-term source of finance. These are required for a year, mostly less than a year. For 1 year is a maximum. So that means working capital loans from the commercial banks and the trade credit are the few examples mentioned here. These are the called as short-term source of finance. This is the first category, that is basing on the time. Next one is basing on the ownership and control. So it is it is divided into again 2 categories. One is owned fund and the one is borrowed fund. So owned fund means, what does it mean here? This fund is financed by the company owners and that is called as owner's capital. Again, I repeat, this fund means owned fund is nothing but is financed by the company owners, also known as owner's capital. So who will be the owners here? That means mostly the shareholders. That means the capital is raised by issuing either by the preference shares or by the equity shares or by the retained earnings, etc., etc. So these owners funds are for the long capital funds, which form a base for the owners to obtain their right to control the firm's management and operations. So that sources of fund is called as owned fund. Coming to the next one is borrowed fund. Borrowed funds are nothing but here, it is borrowed. These funds are accumulated with the help of some borrowings or the loans for a particular period of time. Actually, if you see, this sources of fund is the most common and popular among the businesses. For example, you can get the borrowings from the financial institutions or the commercial banks or from the debentures also. So this category is called as borrowed funds. So that is the second category of finance called as basis of ownership and control. And the next one is basing on the sources of generation. So again, if you see here, before that, this second category, just now I told you, basis of ownership and control. So there are two parameters here, ownership and control. These two parameters are very important, are an important consideration while selecting the sources of finance for the business. Remember that. So that is why, basing on the two parameters, we call it as who are the owners, who are the borrowers, and who will control it, who are the owners. So that is called as owned capital, borrowed capital. So now here, remember that this owned capital and borrowed capital, irrespective of that, you could find the third category basing on the generation also. What is the generation? That is sources of generation. It consists of two divisions. One is here nothing but the, what we'll say, internally, that is one source. Externally is another source. Internally, in the sense here, what does it mean here? Internally means here, internally means internal sources. What does it mean here? The owners generated the funds within the organization. For example, you take by selling of the assets or the retained earnings or by the equity and preference share capitals also, internally we can get the finance. That is one category. Externally means outside. So this external sources means this type of funds are arranged from outside the business, not inside the business. For example, you take here issue of the shares to the public or the debentures or the commercial banks, loans, etc. all come under this category. So that means here, remember that internal sources are nothing but here within the organization, sometimes by the retained earnings, means retained profits, or sometimes by the reduction or controlling of the working capital, or by the sale of assets also internally we can get it. Externally means here by the issue of shares or debentures, public deposits, loans, etc. all come under this category. So, for example, you take one example, I'll tell you one example, that is sources of funds, the sources of business finance. For example, you take retained earnings or the equity shares, or the term loans, debt, letter of credit, if you take debentures or the euro issue or the working capital loans and venture funds, if you take, all these are is a concept that is elucidated in detail about how we are going to get the funds, how we are going to procure the funds. So whatever I told here, just you see the slide here. So this, just now I told you, this long-term finance is required for the purchasing of the assets. Mostly here, I told you there are two types of capital. One is fixed capital, other is working capital. So fixed capital means is nothing but here. These are, that means for purchasing of the fixed assets. For the purchasing of the fixed assets, we need it. So we need that capital called as fixed capital. Next one is working capital. The running of the day-to-day operations, we need some capital that is called as running or working capital. So irrespective of all this here, so remember that here, we have all these sources of finance. Just you see, shares, debentures, elaborately we are going to discuss in the next slides. Just I'm sharing it. Shares, debentures, public deposits, retained earnings, depreciation fund, term loans from the banks, loans from financial institutions. Come to the short term here. So if you want, just now I told you, for meeting of the day-to-day operations, long term means here, remember that only the first type of finance, that is fixed capital only. But whereas the short term, if you see here, for meeting of the day-to-day operations, we need some working capital, we need some capital called as working capital finance, either for the purchasing of all this raw materials, payment of wages or the salaries, etc., etc. So these are the different sources here for meeting of this short-term finance. Other than this, in the modern sources, you can find all this here newly established sources of finance, that is angel investment, venture capital, private equity, etc. So later on, I will discuss what is this angel investment, venture capital, and private equity later on. So now here, the second slide you see, next slide you see, that is a second classification, that is according to the ownership and control. That means these are those funds that are raised by the owner of the business. It can be raised by the sole person or by the partners or by the shareholders also. So this type of finance or capital remains invested in the business for the longer period of time. So in this, the best example, we can say the equity shares and the retained earnings. Other than this, you could find the borrowed funds also. These borrowed funds are the most commonly used sources of funds, and these funds provide for a specific period on certain terms and conditions. That means it has to be repaid after the expiry of the period with interest. That is very important. So coming to the next classification, this is the next slide here, internal sources and external sources. That is basing on the sources of generation. Internal sources are nothing but are those funds that are within the organization. Basically, these sources fulfill the short and the limited needs of the business. Examples, you take the equity share capital and the retained earnings. So here are some more examples given here. You can see the next slide. After this, coming to the next external sources, these external sources refer to those sources which involve the funds from outside of the organization, not from the inside. That is from the outside the organization. It is these external sources are useful when a large amount of money needed. Suppose, for examples, whether by the issue, some examples are like the shares, debentures, public deposits, and the loans, etc. So here these are the. So irrespective of this here, let us discuss one thing. Here already I told you that I'm going to discuss elaborately. So now here you see the equity shares. Just you see the picture here. So here equity shares. Equity shares are very, very important. So equity shares are the most important source of raising the long-term capital by the company. And they represent the ownership of the company, and thus the capital raised by the issue of such shares is known as the ownership capital or the owner's funds. So thus equity share capital is a requisite for the creation of the company. In shortcut, we can say that it is a prerequisite for the creation of a company. So the persons who purchase these equity shares are called as equity shareholders. Actually, frankly speaking, these equity shareholders do not get any fixed dividend, but are paid on the basis of earnings of the company. Sometimes they are referred to as the residual owners, since they receive what is left after all other claims on the company's income and assets have been settled. Just like, for example, you take in the real sense, I'm telling. For example, you take in your house, you are the owners of your house. Suddenly some guests came. You have prepared some very delicious biryani or something you have prepared. So will you eat first by yourself or will you give to your guests? Obviously to your guest. Guest is important. So that means you are the real owner. Assume that you are the equity shareholder. So who is given preference here first? To your guests. So those guests here in this sense are called as preference shareholders, and you are called as equity shareholders. So in the same sense, if you speak in this sources of finance language, The equity shareholders are the real owners, and whatever, if they want to share any type of dividend, if they want to share any type of profits, first the profits is given to the preference shareholders. If anything is left, then only they will take it. So preference is given to the preference shareholders. That is very, very important. So these equity shareholders or equity shares liability, however, is limited to the extent of capital contributed by the company. So here these equity shares are suitable for the investors who are willing to assume the high risk for the higher returns. So remember one important point, that payment of the dividend to the equity shareholders is not compulsory, whereas it is compulsory for the preference shareholders. Remember that. So just example I told you, you are the owners of your house, you are the owners, means that is one aspect. Your guests are also important. First, your guests are given important. So they are the preference shareholders. Assume that they are the preference shareholders, you are the equity shareholders. Other than their shares, there are other sources of finance, that is debentures, public deposits, etc., etc. Return earnings. So these retained earnings are referred to the percentage of net earnings not paid to out as dividends, but retained of the company to be invested in its core business or to pay debt. This retained earnings is recorded under shareholders' equity on the balance sheet. Remember that. So other than that, here you could find the preference shares also, already we discussed, and this you could find the different types of preference shares also, like the cumulative. 1 minute. Sorry for the interruption. Now we are discussing about the preference shares. So preference shares, remember that there are preferences given for these shareholders in payment of dividend. There are different types of preference shares like the cumulative and non-cumulative, participating and non-participating, convertible and non-convertible, redeemable and non-redeemable also. So here, coming to the next, already we discussed the retained earnings, and the next one is depreciation fund. 1 minute. Depreciation fund, etc. So now here, if you see here, the debentures, already I discussed equity shares, preference shares, debentures. Debenture, what do you mean by the word debenture? An honest man's word is as good as his debenture bond. That is one important quotation. So these debentures are the important instrument for raising the long-term capital. So they are issued by the company, and it is treated as an acknowledgement that the company has borrowed a certain amount of money, which it promises to pay at a future date. So therefore, we call these debenture holders as the creditors of the company also. And here also you could find the different types of debentures like the secured debentures, unsecured debentures, and the redeemable debentures, non-redeemable debentures, registered debentures and bearer debentures, etc. Or the convertible debentures, non-convertible debentures, etc. So the next one here you see the term loans from the banks. So in finance or in the economic sense, if you speak, a financial institution provides the financial services for its clients or the members. One of the most important financial One of the most important financial services provided by the financial institution is acting as a financial intermediaries. Most financial institutions regulated by the government. So these financial institutions provide the service as intermediaries of the financial markets. So what are these financial institutions? There are three types. One is the depository institution, contractual institution, investment institution. So remember that these financial institutions provide services as intermediaries of the financial market. Remember that. Other than this, here you could find the different sources of finance in the short-term purposes also. And here of all this here, the public deposits are very, very important. To the unsecured deposits invited by the companies from the public, mainly to finance the working capital needs. And remember that a company wishing to invite the public deposits makes an advertisement in the newspapers. So obviously any member of the public can fill up the prescribed form and deposit the money with the company. So the company in return issues a deposit receipt. The next one is the lease financing is also there here. Lease financing is the important source of finance. And if you see here, if you see this lease financing is the important source of medium and long-term financing where the owner of the asset gives another person the right to use that asset against the periodical payments. Here for the lease financing, the owner of the asset is known as the lessor, L-E-S-S-O-R, lessor, and the user of the asset is called as lessee, L-E-S-S-E-E. So the periodical payment made by the lessee to the lessor is known as the lease rental. Remember that. So under the lease financing, remember that lessee is given the right to use the asset, but the owner lies with the lessor, and at the end of the lease contract, the asset is returned to the lessor, or an option is given to the lessee either to purchase the asset or to renew the lease agreement. So that is called as lease financing. Next, another important source of finance is trade credit. Trade credit is nothing but is an agreement where a customer can purchase the goods on account without paying cash, paying the suppliers at a later date. Next source of finance, factoring. These are the important concepts only I'm telling. I cannot discuss elaborately in short span. Important concepts as per the examination point of view I'm discussing. The next one is the factoring. Factoring is nothing but it is a transaction in which a business sells its accounts receivable or the invoices to a third party receivable. Excuse me. No. So we are discussing about the factoring. Factoring is nothing but it is a transaction in which a business sells its accounts receivable or the invoices to a third party commercial financial company, also known as factor. So this is done so that the business can receive cash more quickly than it would be waiting 30 to 60 days for a customer payment. Factoring is sometimes also called as accounts receivable financing. Other than that, here you see banks. The financial institution that is licensed to deal with money and its substitutes by accepting the time and the demand deposits, making loans and investing in securities. There are different types of banks, like the retail banks, you have commercial banks also. Retail banks means here it provides the basic banking services to individual customers. Commercial banks means here it provides the financial services to businesses, including credit and debit card, bank account deposits, the loans, the secured and unsecured loans, etc. You could find not only the commercial banks, you could find the cooperative banks, investment banks, central banks, etc. And here in the sources of finance, you see here the commercial paper. 1 minute. commercial paper. Commercial paper is nothing but a short-term, unsecured, negotiable instrument consisting of promissory notes with some fixed maturity. That is called as commercial paper. And thus, we can say that these sources of finance, either basing on the time or basing on the ownership, which are procured by the owners of the business, which may be the sole entrepreneur or the partners or the shareholders of the business, and which are either from the owned funds or the borrowed funds, or either from the basis of the sources of generation also. These are the different three categories of the sources of finance. So thus, we completed this fourth topic, that is fourth unit, that is fourth block, we can say that, that's sources of finance. Other than this, the last concept is modern sources of finance. In that, first one is angel investment, angel investor. So this angel investor is nothing but it is an experienced industry person who provides the need for the starting for initiation of the small enterprises. So these angels invest their time or the experience or the network or the energy in starting of their business, and they invest in their business. Some examples here given in this slide. Venture capital, in shortcut we call it as VC. It's a money provided to seed early stage emerging growth companies. And the private equity is also there. It consists of the investors and funds that make investments directly into private companies or conduct the buyouts of public companies that result in a delisting of the public equity. So thus, with this, we completed the fourth unit, that is the sources of finance. Any doubts in this regard?
No, ma'am. Thank you.
My screen sharing is not coming.
It's coming, ma'am.
Okay, okay.
Thank you, ma'am. Thank you for.
Okay.
Thank you.
So
Thank you, ma'am.
thank you for joining the class. Okay. So tomorrow we'll meet. In tomorrow's class, I'm going to discuss the fifth block. That is the last topic at the same time. Some important concepts. According to you, the important concepts means important questions also I'm going to discuss. That is important, the concept called as important concepts. So tomorrow we are going to discuss the fifth block, and it's very crucial. Please join exactly by 10:30. Tomorrow I'm going to complete the block number 5, and at the same time, at a glance, I'll tell you the important concepts. So I mean to tell that not only to deal only those important concepts, first you go through those important concepts and later on the remaining concepts. Okay, thank you for joining.
Okay, madam, thank you.
Thank you very much, ma'am.
Okay.
Thank you, ma'am.
1 minute. Okay, have a nice day. God bless you.
Thank you, ma'am.
And go
Thank
through
you,
these
ma'am.
concepts.
Thank you, ma'am. Bye.
Bye, all of you.